Hello and welcome to Gold and Silver Assets. It's Sunday the 31st of January 2021. Today I thought we'd discuss something a little bit woolly and philosophical. Last week I mentioned in passing about the geometric shapes that we see in price charts. They're all over the place, aren't they? We see straight lines, triangles and curves, etc. But why does this actually occur? A couple of people mentioned in the comments last week about the role of bots and algorithmic trading. So for today's show, I thought I would discuss this a little bit further. I consider the stock market to be a place of disagreement. Generally, when a stock is bought by a person from another person who is selling it, the two people are effectively disagreeing about the future direction of that stock. And that's just a simple way of putting it. But disagreement, I think, is rife in this arena, and it's normal for people to have differing views. And in the comments section, I don't have a problem with that because that's actually normal, as long as it's polite, of course. The funny thing is that it's not necessarily a case of if one person is wrong, then the other person is by default right. It's possible for both to make a profit despite having differing views. And that's one reason why you won't hear me diss anyone else's views on the market. It's not like it's a science. For example, if I was to say that the atomic number of gold is 79, and then someone in the comments section disagreed and said, no, it's not, it's 42, well, I can confidently tell them that they are incorrect. There's a definitive answer to that can be agreed on. And that can't be said about the market and market price action. Another property of markets is herd behaviour, because it consists of a massive group of emotional people. Those emotions can be very strong and include things like fear, either of losing or of missing out, uncertainty, doubt, and of course greed. And these are the things that move markets. I think that assessing how the herd feels about a particular stock or asset is half the battle. But this isn't an easy thing to do. One potential way of doing this is to talk to different market participants, but then realistically, we're only going to be able to get a small sample, and that might not be representative. We could try looking at fundamentals and try to assess how the market may react. But for me personally, I found this, certainly for the short term, I find it hard to assess how the market's going to react. And often it does the opposite of what logic tells me. But I do find fundamentals useful in the longer term. Another tool is technical analysis, but does this really provide an indication of market psychology? One theory is that human behaviour doesn't change, and the patterns in price action that we see are a reflection of human emotions. Others argue that chart patterns are a self-fulfilling prophecy. So let's say if a trader sees a bearish pattern, then they will believe that the market will go down, causing them to sell. And if there's a lot of traders who see the same thing, that can cause the price to go down. Does that mean that technical analysis is useless? No, I don't think so, because, you know, if there's a bearish pattern and price goes down, well, then it worked, didn't it? So I came from a scientific background, and when I first came to technical analysis, I approached it as if it were some form of science and thought it was an objective thing. But I did learn the hard way that it isn't. And I now actually consider it to be an art and nothing like a science. I think the only scientific aspect of it is the human psychology aspect. And I found that changing my approach in that way actually helped a lot. Technical analysis is not a perfect tool, But then if you think about it, there is no perfect tool in the markets. Just because it's not perfect, it doesn't mean it's not useful. We don't want to throw the baby out with the bathwater. The other thing to note is that it's also a lot more subjective than a lot of people realise. What do I mean by that? Well, the price bars themselves are totally objective, yes. But our interpretation of the pattern that they form is actually highly subjective. You only need to go to the ideas section on TradingView for a particular stock to see the wide array of interpretations for a particular stock chart. Now, this is an example of the chart of the gold price, and if you look at this, if I showed this to 10 people, I'm sure we'd get 10 different drawings and lines of different patterns. So there's a few things. One could be, you might say that this is an inverse head and shoulders. Others might say this is a descending broadening pattern here, and so on. And even support lines and resistance lines do differ between different people. So, you know, this isn't a concrete thing where everyone sees the same thing. Why do we even see patterns in charts? Well, the human brain has evolved to recognise patterns, and pattern recognition is one of the deep core capabilities of the brain. And it was really important to be able to recognise patterns for survival. And we are actually the descendants of those who are the most successful at finding patterns. One of the patterns that we naturally look for is faces, and as we can see by the pictures here, these examples show that you can see faces in all different types of places. And actually, it's not just a visual phenomenon. It's common to actually hear voices in random sounds that are generated by electronic devices. Fibonacci ratios are commonly seen in price charts, and they're widely used in technical analysis. But these ratios are also widely observed in nature. What's the link between stock charts and the things shown here? Well, the only thing I can think of is nature, and that all sounds a bit vague, but the reality is we don't know. And anyway, that leads me to think that it's got something to do with the human brain and human psychology. Having said that price action is created by human emotions, doesn't algorithmic trading change that view? Well, algorithmic trading is where orders are executed using automated pre-programmed trading instructions. The programmer inputs their chosen variables such as price, indicators, or even news. And this is something that has gained traction in the 21st century, and it's thought that over 70% of equity trading is algorithmic. That's a huge amount. Multiple strategies are used, such as market making, inter-market spreading, arbitrage, and trend following, as well as high frequency trading. The big advantage of algorithmic trading over human trading is that it can process huge volumes of data rapidly. It also removes the human emotion aspect of trading decisions. A common misconception is that all of the value here is in the specific algorithm used, and that's actually not the case. These things are only good as the data that's put in. And there are a range of potential flaws with these systems, and that includes things like data mining bias, missed signals, and overfitting of data. We also need to consider the progression to artificial intelligence and machine learning. These would further minimize human inputs, but my understanding is that these aren't widely used in the markets at the moment. If they are, when there's less and less reliance on human input, I wonder what effects that will have on the markets. I don't know. Are algos more profitable than humans? And So I did actually try and look for this, and I actually had a really hard time finding well-conducted neutral studies on this. And I think it's probably something that would be quite tricky to study anyway, because of the secrecy that surrounds this kind of stuff. Algorithms can't be static. The market is a dynamic place where conditions are constantly changing. And so the programming would need to be altered to keep up with those changes. And so at the moment, there still remains human input. And so with the onset of artificial intelligence and machine learning, we would anticipate that that learning would be able to adapt to the new environments. It has been shown that algos did contribute to the volatility that was observed during the flash crash in May 2010. So to me, that suggests that you get effectively an exaggeration of what you see when humans are trading. Apparently, news feeds from Bloomberg and Thomson Reuters are formatted to be read by algorithms. I just wonder, how does the algorithm decide whether the news is good or bad for a particular stock? And, how do they determine how the market reacts? It's hard enough for humans to do that. So I don't know. I don't really understand that. The next question is, are algorithms affecting chart patterns? And again, that's something that's very difficult to study. I don't know the definitive answer to that, but one thing we can do is look at charts before algorithms existed. So over here, we've got a chart of Miami copper in 1945. And if we just eyeball it, I don't think there's anything really obvious to distinguish it from modern price action. In fact, technical analysis only became widely used in the 20th century. And I reckon if we looked at the price action of something, say in the 1800s, and made a chart of that, I suspect we'd still observe similar chart patterns to what we see today. The origins of chart patterns remain a mystery. Why do these geometric shapes form in the price action? Well, as I've mentioned, I err towards it being a natural phenomenon, and I see it as being footprints of human psychology, but reality is I don't know. There are those who do believe that chart analysis is hocus pocus. I think it has its uses, and as long as you understand its limitations, I found that it can be a useful tool, but it's not something I'd use in isolation. It's not for everyone, but at the end of the day, we all have to find what works for us. For me, I think technical analysis is a useful adjunct to help me make profits. Next up, the market update. We've had quite a few thrills and spills this week with the retail investors pitted against hedge funds, and there's been tons of commentary on it, so I'm not going to talk about it too much. But for me, the biggest point is a great lesson that all of us should learn from that. And it kind of harks back to my video about stocks being swiped. From what I understand, that there's a lot of brokerages in America that restricted or halted certain aspects of trading. So, for instance, retail traders weren't allowed to buy specific stocks. And from what I can tell, those restrictions didn't apply to institutional investors, which to me seems very, very unethical. But is it illegal? And so that got me thinking, what are the terms and conditions? What have retailers signed up to? And do they actually know that? And so I had to look through their terms and conditions, and I found a couple of things. So one of them is actually relates to restrictions on trading. And I've highlighted the relevant sections here. So one of them here is that it says, I understand that Robinhood may, in its discretion, prohibit or restrict the trading of securities or the substitution of securities in any of my accounts. So that actually does make it legal. And the other thing is, there's another clause about discontinuation of services. So here it says, I understand that Robinhood may discontinue my account and any services related to my account immediately by providing written notice to me. And, these terms and conditions have been around for years. And I would argue that, most financial paper products have things like this, which is a kind of get out clause. And at the end of the day, none of these things are written for the protection of retailers. So this is something that's really, really important to bear in mind. I haven't really heard many people discussing is that you've got to know what you're getting into. Now, don't get me wrong. I'm not saying that this is right or wrong. I'm just saying, we're a vulnerable group in this respect, and we've got to understand those risks and act accordingly. Let's move on and let's start with gold priced in US dollars on the daily scale. And gold's really just been moving sideways for quite a while now. And as time goes by, I'm getting less and less concerned about price moving into this territory. I actually still think that, at the most, worst case scenario is a dip into here. But again, I think it's going to be brief. We've had this very long wick where it attempted to go down here. And so I've therefore joined these two lows to form a trend line. And let's see if that holds. That'll be quite interesting. If price does bounce off of that, then again, I'd feel even more bullish. But we just have to see what price is doing. I think we've still got a bit more grind to go. But yeah, I don't know. I think it's looking strong. I've still got my chin up. I'm not worried about major bearishness. I am aware of potential downside, but I'm not expecting anything dramatic here. Let's move on to silver priced in US dollars on the daily scale. And silver's shown even more strength than gold. What I've done here is joined these two lows over here to see if, maybe that's the trend line that we should be looking at. And certainly price didn't even manage to reach that trend line before going up again. So we've had a couple of bounces up here. The other positive thing is that price shot up through that 26 resistance level again and went up and then tried to go back through it, but bounced back up again. So again, that's another positive sign here. Will we go back down here? There is potential for that, and that's why this trend line I'm going to be using as a guide. Again, as time goes by, I'm getting less and less concerned about major drops here. A drop to 22, look, it's possible, but I'm starting to feel it's less and less likely. So I'm going to go for this trend line as the kind of maximum drop to expect here. But more likely, I wonder if we're just going to go sideways with this $26 level as support. The other thing to see is that we're getting increasing levels of support below. So we've got this price action here and of course all of this here, which is again going to be supportive. I don't think we're going to shoot straight through to 30 right now because look, we had price moving up and down within this band for a while there, and so that may well occur for a little bit here. The other thing I've drawn is this upper trend line, and that would be something to look for if we think we're going to be breaking out upwards. Now, I'm going to say something that might sound a bit crazy, a bit nutty, but look, it's just an idea. Okay, so this channel, from my point of view, this channel is all about throwing around ideas. It's not about being didactic. So this is just one thought. And I've seen this in a few different charts. I don't know if there's anything to it, but let's talk about it. So if we look at this price action over here, so price went up quite sharply. We had a little bit of a kind of shoulder here. Then price went up quite a bit, and then we had this kind of rounding pattern over here. Then again, we had a similar looking pattern. So price went up, we had this kind of shoulder here. Price went up a bit more, and then we had this rounding pattern over here, after which price shot up quite substantially. So again, you know, as on the way up, we had this kind of rounded kind of shoulder over here, I guess, and then price went up, and then we seem to have this kind of rounded shape over here. So I'm wondering if we're this is just a larger version of this, which is in turn is a larger version of this. Look, I don't know if there's anything to that, but I just found it quite interesting. It's a kind of fractal pattern, isn't it, really, I guess? If that is the case, then what can we expect over here? Well, I would suspect something like this, and then going up through here. We might hit a little bit of a hurdle here before going further. But this would suggest, if this is anything to go by, the next rise will be much bigger if the pattern is enlarging as it has done over here. Look, just an idea. I don't know whether this is going to happen or not. But overall, I'm very positive about silver. I think it's behaving quite strongly. Let's move on to the miners. And so this is the GDX on the daily scale, and we still remain in this downtrend, but we haven't made a lower low yet. And remember that around the 32 level is supportive. I think we might actually go down to there. But I think that's probably going to be the maximum drop. But let's see. Let's move on to silver juniors. So this is the SILJ on the daily scale. And last week I had joined these two lows to draw this channel line. And interestingly, price it didn't quite reach that low, but pretty close, and bounced off it. And that bounce was pretty strong. Now, I know that this drop here was quite scary. A lot of the junior miners dropped quite substantially over that time, and it would have made people rather nervous. But the subsequent bounce was pretty spectacular in individual miners. And where do we go from here? Well, as long as we're in this channel, I'm feeling pretty happy. And once it gets over this 1750 level, so I guess if we get a close above 18 even, I think we're off to the races after that. And I'm expecting a potentially substantial move there, but we've still got a little way to go. There is a gap here as well. That doesn't necessarily have to be filled. If that's a runaway gap, it could just keep going. Yeah, it's interesting because although price has gone up quite substantially, these are three red candles. So I think possibly a dip down, and we may actually move sideways in this range, similar to what happened over here perhaps, before we make that move up. And so that would fit in with silver consolidating a little bit before that breakout upwards. And last week, this chart seemed quite popular. This was the GDX to SILJ ratio. And I thought we'd just take another look at that. There are some problems with that in that it only goes back to 2013. What I would really love is to see something equivalent to this, which includes, in the 1970s, I wonder what this kind of ratio would have looked like for the miners back then. That would be really informative, and to see how that had changed over the years. But what I thought we'd do is compare that to the gold-silver ratio, which I've drawn here in grey. And it does seem to be pretty similar, which makes sense, because the miners are leveraged to the silver price, I guess. And it's interesting, actually, if you look at the ratios themselves, you can see that for the miners, they kind of range between about 1.6 and 3.8. And that's very different from the gold silver ratio itself, which on this chart ranges from about 55 up to over 100. And so I thought that was quite interesting, because that shows that they're not equally leveraged. But that just seemed like quite a dramatic difference in those ratios. Anyone got any ideas about why that might be? I just thought that was interesting. Anyway, that's it from me for today. Interesting times coming up, but keep your chin up. Even if we do get a drop, I'm not worried. I'm still feeling very bullish about all of this. So yeah, let's see what happens. All the best. See you next week. Bye.